Well, welcome everyone to today's webinar titled Supply Chain Finance, Cash Conversion Cycle, and Treasury Ecosystem. This is Brian from Strategic Treasurer, and we're pleased you could join us as we analyze and discuss this section from the latest Treasury Technology Analyst report. Our speakers for today are Paul Galloway, Senior Director at Strategic Treasurer, and Craig Jeffrey, Founder and Managing Partner of Strategic Treasurer. Welcome, Paul and Craig, and I'll now turn the presentation over to you.
Thank you, Brian. Really appreciate it. Paul, it's good to present another in the series on the Analyst report. Thanks for co-doing this with me.
Oh, glad to be here.
And thanks to each of you for spending some time in your afternoon. Wanted to say a few things at the beginning before we get fully underway. All of our webinars have a lot of information. This one does too, but please note we have quite a few more slides than we normally do. So we're going to be moving along quickly, so buckle up. Let's go through our agenda, the Treasury ecosystem. So this sits alongside the Treasury Management System and the ERP. And so this area of technology and solutions gives a broader view, more than just Treasury Management Systems or aggregators or or payment hubs. Includes everything that fits into that space. We'll then cover some information about the framework for the cash conversion cycle, working capital, and we'll take the treasurer's definition of working capital and both an efficiency measure and a capital measure. We'll move down to the cash conversion cycle automation. So whether you call it procure to pay or order to pay, an order to collect, or a different set of codes for that. This will look at those flows that either consume capital and then return it back to the organization in the form of cash, or it's in the reverse order, but it's that influence and inflection between Treasury and then the core parts of the business. So next we'll look at solutions related to supply chain financing solutions. And we'll look at, we'll touch lightly on a couple of the SCF and dynamic discounting options. There's certainly a lot more in the book. Then we'll look at the future of supply chain financing, where will be the usefulness of that in an era where rates are no longer at zero. They've moved off the ground. And we'll look at the difference between the binary of I pay late, you receive late, I pay early, you get it early, to having a third party in the midst of that, and how that changes the environment. Then on the realization side of selection implementation, we'll look at both due diligence, the power of a network, and partnering and making sure that all of the functionality gets deployed and is used in the rollout. That's our agenda. So we'll get right into Treasury ecosystem. As you can see, there's 6 key logos, along with some words that fit here. So what is the Treasury ecosystem? So, core to most companies, there's an enterprise resource planning or accounting system, excuse me, with a core focus on recording things properly, ordering things properly, and then a treasury management system managing the liquidity, the forecast, focused on the care of the balance sheet items of cash, investments, and debt. So what rolls into here? We have things like forecasting, liquidity management that may be separate from a TMS. Could be a liquidity tool, a planning tool, a forecasting tool. Payments and payment security certainly fall into this category as well, as Treasury is the superintendent of payments. That doesn't mean every payment goes through the TMS or through Treasury, but they're responsible for that. So payments and payment security, whether it's in the payment hub or whether it's a specialized validation tool or security tool, those all fit into this arrangement. So foreign exchange, hedging, support for whatever the financial exposures are fit in here. What else is happening? API-driven connectivity for more seamless, more integrated transactions is becoming the rage. It's certainly becoming very popular for information. It's starting its slow ascent, soon to be rapid ascent for payments. And so AI-powered risk assessment tools risk management tools also fall into this category. And you can think of more that belong in here. Things like digital commercial paper is a new thing. You'll be hearing more about that more on other webinars that we share. Same thing with digital letters of credit. The use of blockchain, the use of AI, the use of APIs, better integration are all having a significant impact. So that moves us along then. If we talk about the ecosystem and some of the broader categories, let's look at the financial cycle, the cash conversion cycle. What is that? It's the number of days. It's a measure of efficiency. And so it's defined as the number of days from investing cash in inventory to collecting it from sales, converting it from receivables to cash, and then having it available to reinvest in inventory. So everything you have from your cash that goes into inventory or that goes into receivables is part of that. Same thing with payables. All those are measures of efficiency that fit into the cash conversion cycle. So think of efficiency in terms of days, and not all days are the same from a perspective of how much money is used to fall into that. You'll see that from the next slide. But today, if you look at the bottom, what's the cash conversion cycle? That's days sales outstanding plus days inventory outstanding minus days payable outstanding. So you have cash in your receivables, which is what makes up days sales outstanding, a factor there, or calculation. Same thing with how much inventory do you have, and then you reverse the number of days for days payable outstanding. So as each of those converts to days, that's a measure of efficiency. Efficiency matters not just for operational people, it matters for Treasury as well, because as your organization scales, if you're more efficient, that will have a reciprocating effect on the finance of the business and help you scale. So when we think about AP, AR, credit, collections, all of those as Treasury professionals have at least a peripheral relationship to your organization. For many, Treasury will own working capital and have a vested interest in each of these areas, not necessarily having every area report to them, but will be focused on it. So what's the core functionality? Any system that we're talking about streamlines one or more processes within the cash conversion cycle. Could be billing, could be digital lockbox, could be any form of payments. Who needs it? Companies that look to optimize or improve their working capital management, and certainly companies that are struggling with inefficiency in some portion or most of their cash conversion cycle. So that's almost everybody. All right, so working capital is defined differently by different groups, and let's think about that. So this is two definitions. If I asked you the question, do you want more working capital or less? You might say more or less, depending on what you're thinking. Or if you're thinking of both, holding those two ideas in your head, you might say it depends. So let me get to why it depends. So traditional accounting, the accounting definition of working capital is current assets minus current liabilities. Simple enough. If you remember the balance sheet, left side and right side, the current assets, the upper left-hand side minus the upper right-hand side, current liabilities. This shows how much capital is available to meet obligations as they come due. This is an accounting definition. It's also commonly used by bankers when they're just determining some core credit issues. That's the traditional accounting definition. The other working capital measure, which is oftentimes referred to as the Treasury definition of working capital, is the value of these three items: accounts receivable plus inventory minus accounts payable is working capital. That's the amount of capital you've invested into the cash conversion cycle of your business. Sometimes that's called net adjusted working capital. So that's cash in the business to run that. It doesn't take, how is that different from current assets minus current liabilities? Well, a current asset might be cash. Converting AR to cash makes your working capital use on the right side go down because it converts it to cash. That makes no difference on the left-hand side, right? So receivable becomes cash, exactly the same treatment, and there's different purposes for those. So That's the the focus. The prior slide was about efficiency and ability to scale. This is about how much cash is being used. Both serve purposes, both serve related purposes, but they're slightly different. And so a lot of the vendors provide solutions that help you manage your working capital from a treasury definition perspective. So within the cash conversion cycle. Thank you for that. So we're going to move over to our first graphic chart, which is optimizing working capital. This is from a survey, Treasury Perspective survey. We do this with TD Bank almost every single year. And does your organization place a heavy emphasis? If you look at the numbers, it's kind of a tight scale. It goes from a low of 58% to a high of 68%. What does that mean? I would say it's important all the time. Varies a little bit. You look at the depths of COVID to when interest rates rise, you can see a little more emphasis, but it's pretty much 60 to 70% of a heavy emphasis. For 60 to 70% of corporations place a heavy emphasis on this. No great company can do a great job without having a significant focus on managing and optimizing working capital. All right, we will get to Paul soon, I promise. We have a lot of less back and forth, a lot longer runs here. So Paul will be with you guys in just a moment. So thanks for that. So supply chain finance. What is supply chain finance? You get people arguing about this. You don't talk about religion or politics or definitions of supply chain finance, I guess. But what's the definition that we like? So we become very European minded here. The EBA's definition is the use of financial instruments, practices, and technologies to optimize the management of the working capital and liquidity tied up in the supply chain processes for collaborating business partners. I like that a lot. I would only add the financial supply chain processes, but supply chain processes is probably more correct. So we got to give it to the EBA for a great definition. What does that mean? Does that mean dynamic discounting is part of supply chain finance? By this definition, it would. It would be a way to help that. And whereas some people who are more purists on the SCF front would say, no, that's just a financing vehicle or something different. I'm not saying that to be edgy. I'm just mentioning that there are different views on that. So you understand where we're coming from. But this idea of we use practices tech to optimize how we manage it is part of SCF. And so the core functionality is this idea that there's a win-win solution between buyers and suppliers. And a lot of times how that's accomplished, instead of being win-lose, if I pay later, you receive later. I win, you lose. If I pay earlier, you receive earlier. I lose, you win. There are additional flexibility where a third party comes in, maybe providing funding or sophisticated discount options where maybe I can pay later and you can collect earlier. And there's a slight, maybe a very affordable way for you to collect earlier when you want, when a third party is dropped into that. So that's the definition of the core functionality. Who needs it? Buyers and suppliers who want stronger supply chains, which means keeping their counterparties strong. Maybe you need some additional flexibility and leverage to improve your working capital even more. This is a way of doing that. And then if you have significant liquidity fluctuations, having an additional lever matters quite a bit. So we're stepping lightly. I told you we had a lot of slides. We're up to slide 10 before I got to our first poll question, which might be a record in the last 2 years. So we're at slide 10, challenges in the cash conversion cycle. So this is where you answer the question. You get to pick one. So this is which area of your company's cash conversion cycles presents the biggest challenge. Now, this is your best guess. Days sales outstanding, this is receivables. Days inventory outstanding, this is related to the goods that you acquire if you're selling goods. Or days payable outstanding. So this is your AP activity, how much you're paying. If you're unsure, click the unsure circle and then hit submit. We'll give everybody just a moment for that. And Two things. After you've hit submit, I would invite each of you to look into the chat box. There is a download the report. This is the analyst report. Go ahead and do that and fill it out. And if you haven't followed Strategic Treasure, please go ahead and follow Strategic Treasure on LinkedIn. That would be awesome. And if you write the, let's just say ecosystem in the chat box, if we have 100 people who type the word ecosystem or poll, we'll go ahead and send out the results from the polls from today's webinar. Okay, we've got the answers here. And Paul, you'll be up after this, but I'll go through these quickly. So AR side, number one, 41%. DPO, 16%. And then a little bit behind that, we've got days inventory outstanding. So I think that makes a lot of sense. Not every company has physical goods or inventory, so that should be lower. DPO, everyone has that. I would say that DSO is far and away number one, especially if we have 30% who are unsure at this point in time. Paul, a lot of people thought I was going to say and cover all the slides, but that's not true. We're going to cover cash conversion automation.
Yeah, thanks, Craig. So we're going to step back towards something that Craig mentioned earlier, definition or Treasury's definition of working capital. What is that? Well, the components are here on the slide in the form of procure to pay, inventory, and order to collect. So we're going to talk about those components here. And when it comes to procure to pay, you have some competing KPIs within here. Your procurement team is focused on the supply chain. And what's going on in the supply chain? Is it going to be reliable? Are you going to get inventory that's not damaged, it's high quality? These are the things that procurement is focused on, where your payables team is going to be more focused on, maintain your controls in the process to pay. And they'll have a desire to push out the days payable outstanding. They want that to be above the minimum. They want to pay out later if they possibly can. Hold on to cash a little longer. When it comes to inventory, a lot of businesses get focused on, and this is important, you should be focused on this. How much inventory do you have? Is it the appropriate level? Has it been optimized? As an organization that is a manufacturer relies on supply chain and has customers that have a certain level of demand, when you have excess inventory, that hurts you. You have money that's not being put to use. You've spent money to get inventory, but you're not receiving cash back in. Flip side is you have high demand by your customers. You don't have the inventory to be able to meet the demand, and so the flip side happens. So inventory, having a balancer, is important. I know in this slide we talk about just in time versus just in case. An example of what that means is, think about COVID. Pre-COVID, a lot of focus on inventory management was just in time. You get it there just when the customer needs it. But when COVID happened and supply chains were disrupted, there was a focus of just in case. Let's make sure we got something just in case. We got to make sure we have access just in case. So the dynamics of inventory changed. When we think about the order to collect side, this is a process of, selling your inventory. You got inventory, you got to sell it. You can leverage somebody else's credit to pay for things. Keeping losses and unpaid balances to a minimum is a focus. So you get inventory that goes out. You want to make sure that you don't have people that aren't able to pay, or you're not able to collect. You want to keep those losses down, those unpaid balances. You can also look at it from a perspective of incentives to pay. How do you want to balance that out? Is the quality of sale good? Is it going to be sticky, or are you going to get paid? Of course, fulfillment being timely is pretty important from a customer perspective, but it's also from the company's perspective when it comes to the supply chain, being able to manufacture, develop the product. Invoicing and billing in a timely fashion is also very important from the collection standpoint. You don't want to have something out there that's outstanding longer than it should be. This will slow down your cash conversion cycle if you're not getting the billing out there and you're not collecting the funds quick enough. So these are some of the important aspects when it comes to working capital management. Just a little bit different way of looking at the definition Craig mentioned earlier. So I want to dive into procure to pay on the next slide, maybe just a little deeper in terms of some of the opportunities to generate efficiency with accounts payable. And we have a list here of what some of those items are. You think about the ability to work remotely and securely process your accounts payable. These procure to pay processes can help you with the automation and the security of the payment process, speeding up how things are done in terms of approval and processing. It also allows for discounts. You pay early, you can get a discount. Now you can choose not to pay early, you can choose to extend it out. There's kind of an embedded interest rate associated with any kind of discount in the sense that you pay full price or you pay it sooner and you get a discount price. Optimizing your working capital is part of the focus in the procure to pay cycle. Additionally, there's standalone and integrated tools that we have listed here that help you across the whole platform. Your vendor management, those relationships that you have that are really important, helps you manage that and maintain that relationship as well as strengthen it. Helps you from a compliance or regulatory standpoint, especially with organizations that are dealing with a global footprint. Being able to manage the receiving of invoices, goods and services. You can also automate the processes or the tasks that you have by following a procure to pay platform or system. When it comes to the order to collect side of things, there's opportunities there as well. And on this side, we flip to the next slide, Craig. On this side of things, the receivables side is what we're focused on. Certainly opportunity for efficiency gains here. Obviously, conversion of receivables into cash is what your focus is. Can you get that done quickly? Quicker you get conversion into cash, the better you are from a working capital standpoint. And you can utilize that cash to do other things. It's investment in your organization, products, services, or ongoing support of the products that you sell. It can also help you reduce errors and speed up the process along the way. This is another way to, on the flip side, one side being supply side, procure to pay, order to collect, also manages your customer side, your client side, which is also important. So you got to look at both sides of it, and order to collect processes can help you with that. Some standalone integrated tools are there include credit rating and scoring. And sometimes being able to do credit rating and scoring can be a challenge. These platforms can help you with shipping goods to customers, managing that process, making it efficient. And it also helps on the working capital and liquidity side of things. So what are some of the innovations that we're seeing out there today? Artificial intelligence and machine learning. I know we've talked about this in past webinars that we've done, but certainly around AI and ML we're seeing that there's a tick up in the use of this technology, which really is beneficial to organizations. Being able to predict anomalies, detect anomalies, helps you with managing fraud, potential fraud. It can help improve collections and cash application, getting cash in sooner, the ability to take that cash and apply it to things that need to happen, whether it is the payable side of thing or the reinvestment in the organization to further grow it. But it also helps on the payment security and fraud side of things. So that's a benefit of new technology with AI and machine learning. When it comes to networks, a lot of times we think of the Swift messaging network, which does a great job of helping organizations validate payees and manage vendors to prevent fraud. So networks can be real beneficial in that sense. Also from a compliance regulatory standpoint, ensuring that you're keeping with or adhering to the rules that are out there. It can help with payment tracking or payment solutions. When you think about payment solutions, in the sense that they lean into the usefulness of a network or the functionality, which can improve the value to the organization. So I think networks really are, they come alongside and they complement the process when we think about working capital or cash conversion cycle. When we think about the next area being the optical character recognition, this is the ability to perhaps take a PDF invoice, scan it. It can read the invoice. It can ensure that the information is put into the system correctly. So this is an automation method. It reduces errors and makes it easier on your organization to manage that side of the invoicing process. The next slide, we have some data on AI and Treasury. And Craig, I don't know, I think you were going to make some comments around this particular slide here when it comes to areas that are expected to be impacted.
Yeah, so we've been covering the ecosystem and jumping in and out of different areas, and Paul started touching on some of the AI on the innovation side, right? AI is impacting so many areas. Where are your peers seeing it impacting? Number one, cash forecasting. Cash forecasting is very interesting because that comes up so much. It's a top area of focus. You'd spend more time doing it. You want to invest in it heavily. You have to run more models, and it's not really that surprising that it's number one for, we expect AI to address it there. The ability to detect patterns certainly falls well into the wheelhouse. So 2/3 of your peers expect that to be the case. Manual reconciliation tasks, there's a lot of matching. The ability of using AI to perform those reconciliations, submit suggestions, or to complete the task is large, very time consuming in different areas of finance. And so that still shows up 5 out of 9, just over half of companies doing that. Now, I will talk about the next couple. So aggregation and or normalization of data. Data matters and data has to be clean. And so using AI to help clean and normalize the data is a great use. Use the machines to fix the errors. That's at 48%. Creating draft reports for internal use, 47%. I would love to know how many people are doing that today to help get reports started. They absolutely have to be reviewed and looked at, but they've gotten much better. Like if you use on Zoom or in Teams, some of the AI tools for summary, sometimes these reports are like, this is great. Other times you're like, nobody said that, but they're getting better. And so creating draft reports for internal use is a good efficiency, a time multiplier used with care, and certainly payment security and fraud prevention with the threat level of issues escalating with the use of AI for creating and fostering fraud. The use of AI and other tools in the defense matter significantly. So those are some of the items that your peers see AI coming to play a role in the overall Treasury ecosystem. I'm sure each of you can think of many, many more. So we'll look at that. On the first poll question, this is what's the main goal with the supply chain financing solutions? What's your primary objective when you consider supply chain finance solutions? Improving supplier relationships, all the way down to we're not considering SCF solutions, or I'm unsure. Select all that apply, and that should logically fit. And we will go ahead and give you a moment to do that. And we'll take a question from Anonymous. So there is yeah, go ahead and fill this out. The question was, can you please name a few cash conversion cycle tools? So I would encourage everybody to download the report. We have quite a few listed in there. Boost works with card activity. Clip handles cash in multi-banks for those organizations that need cash. There's Flywire, Deluxe, LSQ, Trust Me, and Treasury Go help in some aspect of the cash conversion cycle, tracking things, providing working capital management, supply chain financing, streamlined payments, collections, disbursements. Those are some of the ones. That's a great place to start. That's a great question. All right, so we'll go back to the answer. So what do we have here? Number one, as you can see, is enhancing working capital and liquidity. And that's 5 out of 9, 55%. Big dip down to extending payment terms without disrupting suppliers. These are the nice people caught between the, we want to pay later, we don't want to hurt our suppliers because you're either nice, or that will create a feedback loop, which is negative, but good information. Improving supplier relationships, about 1 in 5. Unsure, 1 in 5 as well. Not currently considering, 17%. So 1 in 6 are not currently considering. So 38% not considering or unsure. And then reducing the reliance on traditional lines of credit or credit lines, 12%. So 1 out of, almost exactly 1 out of 8 with the rounding that we see there. So excellent. So great, great answers. In the chat box, I'm told that I should have set a higher number. But we need 40 more people to write CCC or analyst report or ecosystem, and we'll share all those results. Paul, I think I'm doing this next one too. I guess I've got the run, huh?
I think so. Unfortunately, you got the long run. You know, one of the things that I think is interesting about AI, you mentioned how it generates reports for you, and you turn on the summary for calls such as Zoom or Teams. You get that report and you look at it, and you do need to look at it. It's got a disclaimer at the very end that says, hey, you need to check this because it may not be accurate. So, but I do think, to your point, it is getting better. I think it will continue to get better over time. We're going to see less inaccuracy as the code develops. So AI is just going to become a more ingrained part of everything we do.
Yeah, certainly. Great. Thank you for that, Paul. So on this chart, we have the supply chain finance challenges and solutions. Let me break this down for you in 3 sections. So the old model is payment is made and payment is received, right? That's the zero-sum game. If I extend this out, like the win-lose, right? You get it, you collect it later. If I pay sooner, you get it earlier. So I lose and you win. So this is the old model, and this is really a description of if I make a change, it's equal. It's equal and opposite. You know, I get better by the same amount, you get worse. Now, the supply chain finance, the general concept, this is how we look at it, right? We do love EBA's, or Euro Banking Association's definition, but here's how we would look at it, right? There's the payment. I want to extend my payment terms from this middle dash line. I extend it later. But you may, if you're my trading partner, may want to collect this sooner. And so this idea of I'm changing the dynamics here. Maybe I have third-party financing or something else where I extend it, my payment, so I'm paying on day 55 in this case, and yet you're able to collect on day 15. So you got 15 days better, and I got 25 days later on my disbursement side. So we both had some winnings with that. So we managed liquidity, and yes, there's some costs in that. There's the time value of money that fits in here, but this means there's more flexibility. I may not want to break my counterparties by paying them 10 or 15 days later. That may ruin them, make it harder, may create a situation where they're going to have to charge more because they're unsure of when they're going to get paid. So this provides some additional flexibility, and it's certainly useful to have that additional flexibility. Now, I did want to spend a moment talking about one particular SCF method and then another without going through all the options. There are a lot of options. There's seller-directed SCF, there's buyer-directed SCF. And so this is reverse factoring. Now, factoring, for those in the US, factoring isn't particularly common. It certainly doesn't have a great reputation from a perception standpoint. It's perfectly fine. Most of the world, or a huge portion of the world, uses reverse factoring, and it uses factoring. It's considered a perfect way to manage things. So I can factor my receivables. I get a receivable. It's due in 35 days or whatever from a reputable company, and I can factor it. In other words, let's say maybe I get 90 cents on the dollar, 97 cents on the dollar, for example. I can get that today, and then the factor pays me that, and then my customer will pay the factorer or will pay the financing organization on day 30 or 35, whatever it was that I sent. So that's the receiver oriented model, or the the seller driven model, right? I'm the seller. I have money coming into me, but I want it sooner, and I use a factor to do that. Now, if I'm a buyer, you can use reverse factoring, right? So I want to extend the terms when I pay, but I want to offer earlier pay for a discount purpose. So as the buyer, I want to increase my DPO, but I don't want to break my suppliers. So I work on a reverse factor so somebody else can get in there and pay them sooner. So I can still pay late. They can still collect sooner. They can reduce their DSO. And there's a discount factor that they get for taking it earlier, and it allows me to extend it. So that's an example of reverse factoring. So there's factoring, reverse factoring. There's quite a few other options that are either buyer or seller denominated or network denominated. A lot of you said, I'd like to see a triangle chart that explains dynamic discounting. So we have exactly that. So it's our triangle chart of this downward slope. So consider discount terms. Some of those popular discount terms are 2%, 10, net 30. So if I pay the invoice that says that, I receive it today, it was 3 days old. If I pay it in 7 days, so in 10 days, I can take 2% off of that invoice. I like that. I'll pay earlier. Or I have to pay the full amount in 30 days. So I'm going to pay in 10 days or 30 days. And maybe I can't get an invoice approved in 10 days. Maybe as it runs through my process, it takes me 15 days. I would like to pay early, but I'm not going to, pay 15 days early, get no value for it. So, the 2%, 10, at 30, those are the two options. So there's a lot of payoffs at 10 days, and then at 30 or slightly more. What dynamic discounting says is we have automation tools that will allow us to calculate those differences very quickly. So if someone gets approval, they want to pay earlier, it's day 14. They pay day 14, and so it's less than 2%, but it's not zero. So it's roughly the equivalent or close to the equivalent yield by paying earlier on that. So dynamic discounting offers a complete flow. So hopefully that's clear. It's a great way of doing things. Some don't consider that SCF. It's just a way of discounting. Yet, if you look at the EBA definition, it fits in there in some way, right? So something to use and consider. Now, how focused are people on working capital? What's their position? What are your peers doing? Where are they sitting? One of the things I find interesting is, look at the top. It says we're always in excess cash position. About a third of firms are always running heavy on the capital side. We're number 3. We're usually in an excess cash position, 24%. Then about 1/4 they fluctuate. There's certain times of the years where there's a lot of cash flowing in, other times where they're borrowing funds, it's a larger decrease. So it's more seasonal. Certainly, that's a fit for understanding I'm always needing cash. I need cash sometimes. The more flexibility I have, if I'm variable, that matters a significant amount, and I need more caffeine. So there we go. So that's the chart. And there's some we're usually in a deficit or a surplus, usually are always in a cash deficit position. So that's some more survey information for you. And Paul, solving that problem for the hybrid situation, maybe you can talk us through this.
Yeah. So that hybrid number, about 1/4%, or 25%, I should say, we're in that area. So it's this idea or this concept that I live in times of where I have less capital or I have excess capital. So these may be scenarios of cyclicality. So you don't always have capital when you need it, or you have excess capital and you need to do something to leverage that capital. And so the reverse factoring and dynamic discounting come into play. You can leverage your own capital or third parties' capital, or credit, I should say. You can leverage your own credit and a third party's capital to get access to capital. Or in the scenario of you got access, you can leverage the excess capital and utilize that. You put it to work. When we think about impacts about citing or the use of these particular things, whether it's reverse factoring and dynamic discounting, a couple areas come into play that you should consider. One is interest rates. So when we think about interest rates, when interest rates are high, it's tough on suppliers. It's challenging to obtain funding, making alternative forms of financing, such as SCF, more important. So interest rates can come into play, or it could be from a standpoint of compliance or regulatory aspects. Your know your customer can help with managing those things around cross-border or regional compliance benefits, providing that visibility, managing documentation associated with compliance or regulatory aspects. And it makes disputes easier to resolve for organizations. So this gives you more flexibility, helps you manage those things that you need to manage, perhaps in a different way. So you can toggle back and forth between the two. And there are certain organizations where this really makes sense. Cyclical nature of your business certainly could come into play for a hybrid situation. I think when we think about working capital trends, Craig, we have some data that tells kind of some of the things that we're seeing today in terms of what's going on with working capital. There's certainly been some changes, technology out there, the use of third parties, vendors, financing, and other things. So what does the data tell us?
Yeah, so this question we asked over the time domain of 2 years. So what's happened with working capital over the past 2 years? So this is the time period of rates coming off of zero and 32%, so 1/3 found that their working capital improved through internally driven initiatives, the use of automation. We also saw a significant amount of investment there, reduced processing costs. That was number one by a significant margin. Dropping down to about a quarter, it stayed approximately the same. So one out of four didn't have any change in that 2-year period. Then we're back on the improvement cycle with improved through both internal initiatives and external financing. So certain things you might do internally to improve parts of the cash conversion cycle and how working capital is used, or getting a third party to provide support. 1 out of 9 indicated it deteriorated. So not everything is positive. Some things are a challenge. And then lastly, improved through external financing. This third party mix, and there about 1 out of 11 saw that. So 3 improvers, 49, 58%, and at 35% either stayed the same or deteriorated. So mostly it's an improvement, and that's a factor of people investing in it, spending time in it, and making sure it works. So what's the future of supply chain financing? Well, the economic conditions matter. Costs can change dramatically. That can create a need for financing. What's the impact of tariffs on your particular mix of business? What's going on with interest rates, right? They rose off the floor. They were at, in the 5% or more for, zero risk rates. Yours may have been 6.5, 7, 8, 10, whatever. That has an influence as well, because the higher the cost of funds are and the less the availability of funds are, the harder it is to either pay those interest rates or secure the capital. And so that's a situation where, compared to 3.5 years ago, we weren't worried about the cost of funds as much. This is certainly having influence on how an organization finances things. And therefore, supply chain finance becomes more important when interest rates are up off the floor. They're not zero or close to zero, they're higher. I'll jump down to emerging technology. So what's the future of supply chain financing? A couple factors, right? The greater use of AI to determine, risk, what's eligible for financing, is certainly having the play in it. But I want to mention networks as probably most important, right? The fact that we have, purchasing, distributing networks. What's the value of a network? How big is it? What you can do on it? And so networks that involve the cash conversion cycle can leverage, hey, I can pay more people this way. I can capture information better. I can forecast better. I can distribute the cost of a program like an SCF program more effectively. I can protect myself. I can scale better. So networks are extremely compelling option for having a partnership or securing a solution that increases in value over time. I think that's probably one of the most important things. So SCF rates aren't going to zero. They might be going lower. I think most people think they're going lower, but they're not going to zero. And therefore, SCF is more important than it has been in some of the recent past, and we think will continue to be useful. And the fact that technology helps you comply with trading partner information, it helps you manage your cost of goods very significantly, it helps you scale. Those are all very powerful drivers for continued growth in the use of SCF through your banks, through fintechs. It's just another lever that's easier to use, that was previously only available to the largest of organizations and is now available to more and more organizations, more and more companies. Paul, this is your question.
Yeah, I'll take this one. Just before we go on to our poll question here, we did have a question come in, Craig. Do you provide training or short-term courses for Treasury? And this came in on our webinar chat. And The short answer is yes, we do that, and we do it in various ways. If folks are interested in something like that specific, we're more than happy to talk to you about what your needs are and how we can meet those. Craig, I don't know if you have anything additional you'd want to comment on that, but it's kind of the short answer.
No, that's good. Good answer. Yeah.
So our third poll question here, what is the biggest obstacle your company faces in optimizing working capital? This is a single choice. You can only pick one. So lack of visibility into cash flow and liquidity, limited access to financing or credit, inefficiency payment cancellation or collections processes, supplier resistance to extend payment terms, internal misalignment between Treasury, procurement, and finance, or other or unsure. Um, I'm interested to see how this might play out because it could be something that's quite even, or it could be something where there's one area that a lot of people struggle with because it depends on the organization, what types of supply chain financing they utilize, how they manage processes. So this will be interesting to see what the outcome is.
Yeah.
Certainly optimizing working capital, managing your liquidity is really important to companies today. And it looks like the results are up. Well, the largest pick was other or unsure. And the rest of them kind of were close generally. We have three that were close together. Inefficiency payment collection processes, lack of visibility into cash flow and liquidity, supplier resistance to extend payment terms. These three are all kind of falling within the same bandwidth, 15 to 20%, followed by limited access to financing or credit or internal misalignment between Treasury, procurement, and finance. So what I would say is, in terms of if you're unsure or these are some of the challenges that you're facing, I think we probably have addressed some areas where you could utilize approaches to address some of these challenges that you're facing, from cash conversion cycle, managing that liquidity and working capital. So anything that stuck out to you, Craig, that was maybe a surprise?
I would say the limited access to financing or credit seems low to me. And I think this was a select single choice. So that's the hard thing. So if this wasn't single choice, I would have expected the limited access to financing and credit to be notably higher if it was just one of them, because small organizations still have generally have a lack of ready access to financing and credit compared to their large commercial and large corporate peers.
Yeah, I think that's a good point. Maybe if we're to do this particular question again in the future, maybe it's select all that apply, see what comes up. Might have a different response ratio then.
Yeah, that's why we can't ask 400 questions in a survey, right? So
Yep.
There's a question from an attendee. It says, do you foresee the use of supply chain finance to significantly increase due to the variety of new tariffs? Here's a few thoughts on this. I want to answer it with a yes or no, but I want to answer it with some calibration, right? And it will be responsive, right? Not like we see some question answers, right? Do I see it increase? Yes. Will it increase? It takes a little while to spin them up. So depending on how impacted a particular industry is, the more relevant and urgent that would be. And so certainly some industry verticals would be a very significant factor. Others not so much. The other factor is tariffs. How long do they run before they accomplish their objectives, like some of the stated objectives of reducing fentanyl. Does that short-lived? Is it geared towards having purely reciprocal arrangements for trade that are open, or there's a limited number of protected enterprises? If it's short, I don't see it increasing significantly. If it's extended or becomes extremely large, then there will be a significant rush to increase that because the cost will be more dramatic. That will tap into lines and probably margins. If it's very short, then it won't allow it to increase significantly. It might just create some additional pressure on it. Paul, you agree or disagree, or any other color on that?
No, I definitely agree with what you're stating there. It's just a matter of what the objective is of what you want to accomplish with the tariff. There can be different objectives. So I think that's really kind of a big driver.
Right. So everybody should look towards some other information on tariffs and the current situation from our research arm shortly. Well, selection and implementation, just a few things here I want people to look at, right? When we look at due diligence, supplier participation across the board, when you look at selecting one of these partners in the Treasury ecosystem, the cash conversion cycle ecosystem, however you look at it, what's essential? Two things that are covered by the due diligence and supplier participation. Are you looking to acquire a service or a solution that increases or decreases over time? Now, everyone's going to say, I want something that increases over time. So that's not the purpose of the question, but are you doing your due diligence to find, are they stable? What's their business model? Are they feeding that business model? Are they increasing the value over time? Because then it becomes an asset that increases over time versus this development cycle that becomes less valuable at some point and then decreases to oblivion. But think about the factors that lead to that. What leads to an asset increasing over time? One, are they using good technology, modern technology? Is that integrating with other systems so that the interplay, particularly in the cash conversion cycle, goes back and forth? Are they on a network or using a network? That's part of integration. The power of a network, its size, what you can do with it, and how it's changing. What's its trajectory? If its trajectory is good and it's significant and growing, that's a key driver in making an asset that increases in value over time. So networks, services, and how it leverages information. Data is extremely important. Information analytics, vital. And so the last thing on this, when you're selecting a supplier, you're looking through it, whether it's through a bank, through a fintech. One of the ones in our Treasury Technology Analyst report, a key factor is not just those things, and not just can we implement it, but you can implement the technology, but are you going to be able to bring on the type of adoption with your trading partners inside the organization? So your customers, your suppliers, if you can convert that implementation to full adoption, you have a bigger lever where your value increases over time. With that, I want to thank Paul and you for participating in this webinar. Thank you for your notes, your comments. I'll turn it back over to Brian, who has some information about downloading a report and some other closing announcements. So thank you for your time.
Thank you, Craig. Thank you, Paul. And thank you, everyone, for joining us today. The CTP credits, today's webinar slides, and a recording of today's webinar will be sent to you within 5 business days. And be sure to download the Treasury Technology Analyst report by clicking the link in the chat box. Thank you, and we hope you have a good rest of the day.